Right now, self-proclaimed stock market gurus are flooding your social media feeds. They flash luxury cars and claim they got rich overnight by day trading crypto, timing the market, or picking individual hot stocks. They make it look easy, exciting, and incredibly lucrative. But here's the cold, hard truth that Wall Street doesn't want you to know. It is a statistical trap designed to make them rich off your trading fees while you take all the risk. Trying to beat the stock market by guessing the next winning stock is an exhausting, high-risk game. In fact, major financial studies consistently show that over a 15-year period, more than 80% of professional, highly paid Wall Street fund managers fail to beat the average return of the overall market. If the professionals with supercomputers can't do it, why should you risk your hard-earned cash trying to play their game? Welcome back to Finance Fluent, where we translate complex money into plain English. Today, we are breaking down a simple, stress-free investing asset that lets you stop gambling and start building reliable wealth: index funds. If you're completely new to investing, think of an individual stock as a single egg. When you buy just one company, like Apple, Tesla, or Nike, you are putting all your eggs into one single basket. If that specific company faces a massive scandal, encounters supply chain issues, or goes completely bankrupt, your money goes down with it. Your financial future is entirely dependent on the survival of one brand. An index fund completely solves this problem. Think of it as a giant financial gift basket. When you buy a single share of an index fund, you aren't buying just one company. Instead, you are purchasing a tiny, fractional slice of hundreds, sometimes even thousands, of the world's biggest, most stable, and most profitable corporations, all at the exact same time. You instantly transition from being a gambler to being an owner of the entire broader economy. Let's look at the most famous and trusted example on Earth, the S&P 500 Index Fund. An index is simply a fancy word for a tracking list. The S&P 500 tracks the performance of the 500 largest, most powerful publicly traded companies in the United States. We're talking about market titans you use every single day, like Microsoft, Amazon, Google, and Apple. When you own an S&P 500 index fund, your money is automatically spread across all 500 of those companies. This gives you an investing superpower called diversification. Because your money is spread out so widely, your risk is massively minimized. If a few companies on that list have a terrible year, it doesn't ruin your portfolio. Why? Because the hundreds of other stable, thriving companies are there to balance out the loss and pull the broader market forward. You are betting on the long-term growth of American business as a whole. Now, you might wonder, how is an index fund different from a traditional mutual fund? It all comes down to two things: management styles and hidden fees. Traditional mutual funds are actively managed by professional Wall Street fund managers. These managers manually trade stocks daily to try and guess which ones will perform best. Because they are doing manual labor, they charge you a high annual fee, often around 1% to 2% of your entire portfolio balance every single year, regardless of whether they make you money or lose it. Index funds, on the other hand, are passively managed. There is no expensive fund manager trying to outsmart the market. Instead, a computer algorithm simply copies the index tracking list automatically. Because there is no hefty salary to pay, the fees on index funds are nearly zero, often as low as 0.03%. A 1% or 2% fee difference might sound small, but over a 30-year investing career, that tiny fee compound calculates against you, quietly swallowing up to 1/3 of your entire potential retirement nest egg in pure waste. Index funds ensure that your returns stay in your pocket. So, what kind of returns can you actually expect from this passive approach? Historically, over the last century, the S&P 500 has delivered an average annual return of roughly 10% per year. It's vital to remember that this is an average. The stock market is not a straight line. Some years the market might be up 20%, and other years it might drop. But if you practice patience, leave your money alone, and let compound interest do the heavy lifting over the long haul, index funds have proven to be the single most reliable wealth builders ever created. To maximize this growth, successful investors use a strategy called dollar-cost averaging. This simply means you invest a fixed amount of money, like $50 every single month, no matter what the market is doing. When the market is up, your money buys fewer shares. When the market dips, your money acts like a discount coupon, automatically buying more shares while they are cheap. This removes all the emotion and stress from investing. Getting started is incredibly simple and takes less than 10 minutes online. First, you open a free account with a reputable major brokerage platform like Vanguard, Fidelity, or Charles Schwab. Second, you link your bank account and transfer the amount of money you want to start with. And no, you do not need thousands of dollars. You can start with as little as $1. Finally, you search for a low-cost S&P 500 index fund. Common ones include ticker symbols like VOO or SPI, and set up an automatic recurring purchase. From there, you just let time do the rest. Stop letting fear or the illusion of complexity keep you on the sidelines. Building wealth doesn't require a finance degree. It simply requires patience, consistency, and the right system. If you're ready to take full control of your future, hit that subscribe button and join our growing community here at Finance Fluent. Remember, I'm here to help you become finance fluent, not a licensed financial advisor, so always do your own research before making major financial decisions. Now, let's start a conversation in the comments below. Are you already investing in index funds, or are you looking to start your very first portfolio this year? Thanks for watching, and see you in the next one.